I would like to welcome now on stage our moderator from the next working group, which is basically the new Bank Treasury Working Group, Ioannis Bimpas, alongside with his two physical guests, Emmanouil Karimalis and Vasileios Gkionakis. Our third one, Theodoros Stamatiou, will be joining, I think, hybrid?
Yes.
Okay, great, sir. Thank you.
Thank you, Mariana. First, I would like to welcome and thank Mr. Gkionakis, ex-Citibank head of G10 FX strategy, and Mr. Karimalis. He's the director at UBS in the macro rate strategy. We have also online Mr. Stamatiou, who's a senior economist in Eurobank. Welcome, gentlemen. And it's a pleasure to have you in here into this panel. And I hope it's going to be a very insightful discussion for our members. Now, it's undeniable that over the last 3 years, we have experienced some unprecedented global shocks. We faced the partial shutdown of the global economy due to the pandemic. We have a war in Europe, which have led to energy crisis and changes to the energy market. Now, which consequently has led to a peak on the inflation rates, which has led to the central banks tightening the monetary policy. Now, the key question, I think, that runs all over our heads here is, what do you think were the key drivers that led us to an inflation peak of 11% in the UK, 9% in the US, and 9% in Europe? Mr. Karimalis?
Yeah, thank you very much, first of all, for inviting me for this, to talk to this event. It's a great pleasure to be here and discuss topics of common interest and, I guess, hot topics. So, of course, inflation and monetary policy and rising rates are a topic that has attracted lots of attention so far. So, as you rightly mentioned, inflation has skyrocketed over the past year or so. We see that globally. Of course, there are global drivers why inflation has driven, but also we have differences across countries, both in Eurozone, in UK, and the entire world. So maybe a quick flashback. We started the pandemic. We had the enforced lockdowns, and obviously this kept us indoors. We couldn't spend money back then, but this created problems with supply. So the first shock to inflation was, I would call, a supply-driven shock. Most of the advanced countries have experienced this shock. So we had this, we have supply bottlenecks, we have delays in delivering goods, and naturally we had an increase in commodity prices globally, and this naturally generated the first shock in globally, I would say. So after that, of course, during this period, we have experienced a number of monetary and policy, fiscal and monetary policy loosening, I would say. So if we look back on the fiscal side, we have seen, especially in Europe, but everywhere, we had huge budget deficits over that period. We had a number of different programs that try to protect workers, that try to protect households at the second stage from rising energy prices. So this helped somehow for the households and the business to build excess liquidity, I would say, and then led to an increase of demand at the second stage of the cycle when we ended the lockdown. But between the beginning of the cycle, between the lockdowns and the end of the lockdowns, an energy shock as well hit the global market. We had the war in Ukraine. Of course, Europe and the UK in particular were much more exposed to energy shocks. They were more reliant to energy. So this was natural. This was a natural source for spiking in inflation, especially in Euro area and in the UK. But as I said, after phasing out all of these lockdown restrictions, then demand started to picking up. And started to picking up, as I said, because of the monetary and policy loosening. I forgot to say that on the monetary policy part, we've seen all the central banks loosening their monetary policy, increasing their budget, their balances. So we had more QE over that period. We had cheap funding through cheap lending, Teltros, for example, in Europe, that banks even paid negative rates for that. So all of these factors, if I would say, we started from a supply-driven shock. This turned quickly into the energy shock, and then what intensified the increase in inflation was a demand-driven shock. So, of course, as I said, there are differences between economies. Components of inflation are completely different. I think we will probably discuss this at a later stage. But we are now at the period of really high inflation. Of course, full inflation is declining, but is declining at a much lower pace than previously anticipated.
Now, before moving on that, I would like to hear Mr. Gkionakis. I think Mr. Karimalis talked about the European economy, right? I know that your expertise is actually on the US market. Do you share that these were the same key drivers that led the US economy to these high interest rates and inflation?
Yeah, I think there is a difference in responses, but the same mechanism has been in place. And let me go back to the why we've ended up with skyrocketed inflation, not just in the US and Europe, as you said. Because, the number one question that people have been asking me and we have been debating is that, if you take, in order of magnitude, the combined monetary and fiscal policy response during COVID, it is a bit bigger compared to what we had in the GFC, in the Great Financial Crisis. But then we didn't really have any ramping up of inflation, whereas right now we do face a significant inflation problem. And I think for me, it is actually the nature of the shock. Back then, it was an endogenous shock. Everyone was very much troubled. Everyone didn't know the risks that they were sitting on. And basically what you started seeing is that even though governments and central banks opened the floodgates of cash, you ended up with an increasing savings rate. You didn't really have that cash chasing goods and services because everyone was trying to repair the balances. This time around, however, you had an exogenous shock. People did not choose not to consume. They were being asked, either implicitly or explicitly, not to do so. So basically, we've ended up with a humongous excess savings. In the US alone, we've reached a peak. Again, these are estimates based on the trends and everything, of around $2.6 trillion sometime in 2021, which means, just over 10% of GDP of excess savings. That was absolutely substantial. We can talk and debate about the war in Ukraine and Russia. These are, temporary shocks. For me, by far the most important shock has been this accumulation of excess savings that was basically met up with an immediate opening up of the economies. And in the US, it was actually a bit more pronounced, largely because the stimulus was actually less targeted and it was bigger in size. In Europe, the stimulus was far more targeted, and therefore that's why you have different distributions of excess savings. But I think the bottom line out of this, which also is, I may try to jump a bit ahead of the conversation, is that as these excess savings are being depleted, this is why, including the US as well as the rest of the world, I'm not worried about inflation becoming a structural problem.
Okay. And Mr. Stamatiou, what's your view in terms of Greece? How that ECB monetary policy tightening has affected Greece? And also, I would like also to hear your view in terms of what led us to these spikes of inflation globally.
Good morning. I hope, can you hear me?
Yes, we can.
Okay, good morning. It's a pleasure to be in this, to participate in this conference. Apologies for not being there, but as I already told you, I'm positive on COVID. So
it is a pleasure to have you online as well.
Yeah, it's better for you, not me being there. Well, the key drivers, as already mentioned, were the supply shocks, either from the pandemic or from the energy crisis caused by the Russian invasion in Ukraine. That was the first. The second was the increased money supply from the support, from the pandemic support measures that created increased savings not used in 2020 and not 2021, but now these savings are in the market. The people have more money in inflation terms. The people have more money available to buy the same goods as before. So this drives prices up. And the third key driver is expectations. Inflation is here. People see inflation and expect that inflation will persist. So they incorporate inflation in their calculations. And this creates more inflation because they demand higher wages. Firms increase prices in order to incorporate the higher wages, and thus inflation is increased. So the scope of the central banks here is to stop this expectation spiral by using their policy rates. So we have all these increases, and the drawback in this conversation, in this situation, is that usually the increases in policy rates cause recessions. Okay. And we have slower growth in Eurozone. Because you asked about Greece. In Greece, okay, there is no such an effect so far from in growth, because we have a lot of additional drivers of growth, namely the European funds, which add up something around 90 billion from 2001 to 2017. 90 billion of additional investments, and so this is the key driver of growth for the remaining years. But obviously the higher prices are a burden for the people in the country, and okay, they push down. Well, in the absence of such price increases, the GDP growth, which would be better compared with what we expect now, which is around 2% for the next years. Okay. So that's for me.
Now, gentlemen, it's been almost a year now where we have seen all these central banks tightening the monetary policy, and I would like to ask, what do you think how the market has currently responded so far, and what do you think that will be the real consequential longer-term effects of these interest rate spikes? Because we know that the market operates with a lag, right? Chief economists argue that the lag could be from 12 months to 18 months. We've seen these consecutive interest rate spikes for almost 14 consecutive ones. Do you think, what's your view in terms of, Mr. Gkionakis, I would like to start with you. In terms of the US economy, how do you think that the US economy and the market has reacted so far?
Right, so let's make sure we get it right. The market itself responds contemporaneously. It's the economy. It's the underlying economy that is going to respond with a lag. Mm-hmm. And I think if the question is about the market, I think the market has behaved pretty much as one would have expected, where you have seen equities rallying on the back of good expectations about growth at the beginning of the year, and right now there is some consolidation on the back of expectations that monetary policy is going to start weighing on the economy. Now, in terms of the lag, it's quite different. It's quite difficult because the empirical history that we have about the impact of monetary policy on the underlyings of the economy is a bit varied. Yes, it is between, I've seen research that goes between 9 months all the way up to 2 years, but then again, we have to take into account that right now, the impact on financial conditions is much faster compared to what it was in previous decades, largely because people have now much better access to equities, they have much more access to lending and borrowing. So I'm a bit skeptical about how far along the curve the impact is going to be felt. But I think going into,
in terms of the economy,
yeah, going into 2024, for example, I think a lot will depend on how sustainable the inflation, or let me put it differently, because inflation has started going down, how sustainable the inflation decline is going to be, which for me, it will be. And if that's right, how much convincing for the central banks it will take to start cutting rates. Now, this is a bit debatable, of course, because of the terrible communication back in the summer of 2021, where, you know, every central bank characterized inflation as temporary, and then they had to backpedal. My bottom line is that right now we are in a slowing down economy. And I think that's largely because of the monetary policy tightening, the depletion of excess savings. But whether this is going to materialize, to ramificate into an actual outright recession, I think it will depend on the sustainability of the inflation decline and when monetary policy easing is going to start taking place. My view is that I think we're going to start seeing monetary policy easing in 2024. So I would expect that we're potentially going to get away with either a pronounced slowdown or a mild recession. But again, there is a big question mark about how much convincing of the inflation decline is going to take for central banks to start easing policy.
Okay. Mr. Karimalis, in terms of the Europe and the European economy, how do you think they have reacted so far, and how do you think that are the key risks going forward?
Yeah, so in terms of market reaction and central bank reaction function, of course, as Vasileios said, markets react immediately, right? So, of course, at the beginning of the hiking cycle, there was a lot of uncertainty around where the policy rate is going to be. Everyone was speculating. The central banks have been wrong in forecasting inflation, and obviously this created more uncertainty and more volatility, especially in the front end part of the curve we discussed before about volatility. So it is natural for the market. Short rates shifted higher, and we had a parallel shift, rates higher across the curve, and the curve inverted massively. So in terms, of course, on the impact of the market, this is, as Vasileios mentioned, it's much more debatable and depends on a number of factors. Number one factor, of course, is the monetary policy, but of course this is a function of inflation outlook. And inflation outlook is a function of how well the economy is behaving. And in particular, I think we discussed to mention that, which is quite important, and this is one of the areas that all the central banks are focusing on right now, it's the labor market. So the labor market is still very, very strong, both in Europe, in the UK. In the UK, much tighter, I would say. That's why you could some of the discrepancies across the economies could now be attributed to core inflation, and the biggest chunk of this core inflation is coming from services inflation, which is highly correlated to wage growth. So and the impact is still, of course, we see the slowdown. We have a revision of the growth down, but still, everyone, I think it's consensus right now that we are expecting low growth rates. I think even the market now has repriced the probability of a recession, at least in Europe. We see now higher rates staying for longer. So I think consensus is now that we are not probably entering into a recession. It's more of a stagflation problem, but I'm a little bit less optimistic than Vasileios on the inflation outlook. I think that still it will be bumpy. It's not only about the labor market that I mentioned before, which is tight. Of course, the labor market is weakening. It's weakening in the US, it's weakening everywhere. But if you see all the measures that we use to capture labor market tightness, they are still above pre-pandemic levels. So this means that still the labor market is pretty strong. So this, in my view, this implies that nominal growth rate, nominal wage growth will remain still elevated, and this would keep core inflation quite sticky, I would say, and this would imply that probably rates will probably remain at a high level, a little bit probably more higher, but at a higher level for longer, and this is what the market is now actually pricing.
Now, we've seen that it's been more and more the central banks. We have seen previously the market being more and more relying on the market data, labor, statistics, core inflation, and now we see more and more the central banks rely on this data. And people argue that, the chief economists argue that there is a very short sightseeing from the central banks, and probably they might miss the big picture of what's going to happen in the future, in the next year or two, because everyone is expecting what's going to be in the next meeting of the central banks. So we go in month on month, on consecutive months, and do you think that there is a probability that the central banks might miss the big picture? Vasileios.
Well, I think, first of all, we have to acknowledge that monetary policymakers are humans. I think what's really happening is that we are gradually moving towards a more transparent environment in which it's being relatively openly conveyed that these people don't know what the hell is going on. Mm-hmm. So, and I think that's really what's happening. And I think what complicates is pretty much what was discussed before about the labor market. So here's my main issue with tight labor market transpiring into high inflation. First of all, we have to talk about, when we talk about inflation rate, we talk about the growth rate of the price level. So that's one thing. The second thing is, let's not forget that we're coming out of 2.5, well, let's call it 2 decades, where that relationship between labor market tightness and inflation was pretty much non-existent. And I'm not convinced that such an exogenous shock and all the monetary and fiscal policy response that came back actually restored that relationship. So for those of you that know it, it's called the Phillips curve, where it's a negative relationship between unemployment and inflation rate. Lower unemployment implies higher inflation because of higher demand. And I think what complicates things for central banks, and that's why that is the case, is that all of a sudden we seem to think that these relationships have been resurrected. And I don't think that it has. So in economic jargon term, I think the Phillips curve was flat to start with, and what happened was because of the monetary fiscal policy response, you had a shift upwards in the Phillips curve, but that doesn't necessarily mean that the slope has changed. And now, as monetary policy tightening is taking place and the excess savings are being depleted, this is going to start coming down. So that's why my point is that we could end up with tight labor markets and low inflation rate, i.e. the pre-pandemic era of 2 decades. And I say this, and the biggest evidence for me is that over the past 9 months or so, where we had a very synchronized and rapid monetary policy tightening, inflation expectations, whether they are survey-based or market like break-evens, they have gone down sharply. And by the way, it was the first time ever since we have had data recorded, that we had such a massive gap between spot inflation and inflation expectations, meaning that, yes, inflation expectations rose, but they did not follow spot inflation. And I think and for me, this is testament to the fact that we're not going to get with a structural shift towards higher inflation. But I'm saying all this just to mention that this is indeed a very, very complicated picture. And I know, and I mentioned before about the blunder, the communication blunder of the Fed, but if I want to be honest, everyone back then thought that inflation was temporary. And, you know, if you ask me, I don't think that central banks did a bad job. Given the information that they have had, they've actually done a relatively decent job. They've tried to aim for the mandate. And basically right now saying that we're going to be data dependent is an easy way for them to acknowledge that, you know, it's a polite way of saying we don't know what the heck is going on, and we're just going to have some forecast models, but, you know, the uncertainty basically the tails of these uncertainty are so fat that basically we're going to be data dependent. I don't think this is a major issue. It could transpire into a major issue if we end up seeing mandate changes, because right now would be the worst time to see a change in the mandate of a central bank. But as things stand right now, yes, they may be losing the big picture, but I don't think that anyone knows what the big picture is with a pretty big certainty.
Thank you. Before shifting to the Greek economy, Manos, do you have anything to add?
I can follow up. There are plenty of things that I could probably discuss based on what you mentioned before, but yeah, going back to your initial question in terms of data-dependent approach, as Vasilis mentioned, right? They have the only mandate that they have, at least in Europe, in the UK, is inflation, and so as soon as inflation is still high, they have to lower inflation, and they have to push inflation back to the target. So, of course, you know, and this is what they admit, right? When they do the assessments, they take into account a bunch of data, either coming from the labor market, either coming from surveys that or market-related data referring to expectations, and also take into account activity data. Actually, the fact now that the market is pricing of a pause next week for the ECB was the fact that Schnabel, one of the most hawkish, I would say, members of the governing council, spoke a week ago, and she referred more to the weaknesses in the economy, and the market acknowledged that there might be some risks ahead, and they now price a probability of a non-hike. So a non-hike event is a much probable event. So they do take into account, I think, but ultimately their goal is, you know, inflation, and they have to live with that.
Okay, perfect. Mr. Stamatiou, I know that I would like to focus a little bit in Greece now. I know that there's been a lot of discussions around Greece credit profile rating. Considering that the global markets are already pricing Greek government bonds under the investment grade, what do you think that eventually will change if Greece actually gets the investment grade? Do you think that that now would actually be beneficial for the moment for the Greek economy and the Greek banking system?
Well, just to add in the previous discussion, well, the main issue is that the central banks behaved on the basis, as already mentioned before, on the basis of the data they had, and I think so far they behaved correctly. The critical issue now is what they will do now. They will try to further to tackle the inflation problem even by causing a recession. I think that they will continue on this. I think that the ECB will continue on this side right now. I think this is the proper move. But we will see. I think that the next meeting is on the 14th. So we will see next week what they will do. Turning now on Greece, there was the narrative for Greece in the last 1 year and a half was obtaining even before the pandemic. The whole thing was delayed by the pandemic. Was the investment grade rating. We are now just one notch below investment grade by the 3 out of 4 major rating agencies. And we are expecting that the investment grade will take place, I think on October 20th is the S&P rating review that day. So I think that we will gain the investment grade that day. Well, so what's next? The things that this was the narrative so far. From now on, the Greece has to find a new narrative. Okay,
Mr. Stamatiou, can you check a little bit your microphone? We can hear you very well. Yes, just.
Can you hear me now?
Yes, we can now. Yes.
Okay. Well, the new narrative from now on and where the efforts of the country should focus, it would be to further implementing the reforms required by the economy. The reforms, we have a list of reforms in the RRF framework that we have to implement, and we also have more reforms. For example, the reform of the judicial sector, the reform of the educational sector in Greece. And these reforms are needed because now we need to attract investments, now more than ever. So, we finished with the fiscal problems. We have primary surpluses for a lot of years now, and we will continue to have primary surpluses. We have low debt levels, assisted also by the inflation, and but low compared to what we had in the past. Okay, not low compared with other countries, but we have declining debt levels. Our indices are okay, but now we need to implement reforms and use the window of opportunity provided by the RRF and all the European initiatives. I told you before that all these amount to something like 90 billion euros up to 2027 in investments, in new additional investments. And so we can use this window of opportunity in order to improve the growth prospects of the country.
Thank you, Mr. Stamatiou. Now, conscious of time, let's move to the final part of our themes now, forward outlooks. I would start with Mr. Karimalis in terms of the ECB. Economists that currently expect a pause by the ECB argue that the recession is now out of the horizon, or at least a long-standing one. Do you think that stagflation is now the key risk for the euro area? And what's your prediction for the European economy long-term?
So let me convey the house view here, not the personal view. First of all, in terms of, let's say, short-term predictions and about the ECB meeting next week. So our call is for a 25 basis points hike. As I said, the market is now pricing a no hike event, or at least this is much more probable. So why we think that the ECB would hike for another 25, we still think that the core inflation at 5.3% is still challenging. It's quite high for them to pose. Still, the labor market is quite healthy. Nominal, as I mentioned before, nominal wage growth rates in Eurozone are quite high and keep rising, but most importantly, they will come up with the new macro projections in September. As you know, every quarter they update these projections, and we think that they will reduce the inflation profile, but still inflation, medium-term inflation, will remain above their target. So even from the communication point of view, I think it would be very difficult for them to justify a pause there. But as I said, the growth fears are increasing, and that they might end up of pausing, but still it would be probably a hawkish skip. They will likely keep the door open for another hike in similar fashion as the Fed did during the summer. But I think the most interesting question right now, at least across professionals within this sector, is whether when they will start cutting rates, right? How long policy rate will stay at this elevated level. In terms of that, our expectations, we pushed forward our forecast for the first cut by ECB. Initially, we were thinking that the ECB would cut rates in March. Now we have pushed this forward to June. So one quarter more. Of course, this is conditional as well on what we expect about the U.S. economy. But so in terms of the cuts, we think that the ECB will follow probably a much more gradual approach. We are not super dovish. More or less, we are in line, I think, with what the market really pricing now, at least for cuts for 2024. We expect the ECB to cut by 25 basis points per quarter. So we have 75 basis points cuts in 2024 and another 100 basis points cuts. But still, policy rate will remain elevated because inflation profile will remain sticky.
Now, Mr. Gkionakis, it seems that there is a euphoria amongst the news in the US about the economy, about actually a soft landing of the US economy and a slight chance of a rate hike in the next monetary policy meeting.
A slight chance of?
A hike.
Oh, right. Yes.
So
Sorry.
what do you think, how possible do you think that scenario is of the soft landing of the US economy?
Yes, I think it's possible. I think, first of all, the Fed is pretty much done. Is there a probability they could hike another 25 basis points? I think, of course, there is, only death and taxes. But I think, given the developments that we've seen both headline and core, they seem to be in the right path. And given the lags that we've discussed before, I think the risk-reward profile for the Fed is actually for them to sit tight right now and see how this is going to pan out. Now, given the monetary policy tightening that we have had so far, we are quite close to 2% real yield, 10-year real yield in the US. And from that respect, I think with a 2% real yield historically, you can actually get away with a soft landing. Now, there are various things that can actually go wrong in this scenario, and I feel very guilty for forgetting to mention before the number of risks to my optimistic outlook, which is fiscal policy. And right now, US is running quite excessive current account deficits. Now, if this continues, it will put more pressure on the Fed, and then it will become a very, very difficult equilibrium for the Fed to actually be able to calibrate the Fed funds rate to the point where it offsets fiscal policy. So therefore, the risk there is that they can actually overdo it and send the economy into a tailspin, into a recession. And of course, another risk from a global perspective is China, where it's becoming evidently clear that the authorities want to provide a backstop rather than outright boosting the economy and the property sector. So it will be a bit difficult for China to become the epicenter of a global growth rebound. So making a long story short, I think a soft landing is possible, but there are definitely risks as discussed.
Great, thank you. Mr. Stamatiou, would you like to close the topic and with your view on the forward outlook for the Greek economy.
Okay, well, I already mentioned it before, but what we expect is that this is again, this is the house view for me too. We expect a real GDP growth at around 2%, even a bit higher for 23 and 24, and then moving on, we expect that the GDP growth in Greece will decelerate close to the long-term average, which is something like close to 1.4, 1.5%. And also we expect the inflation this year, 23, at 4.6, and probably that this will go down, but above 2% for next year, and it will continue. It will go below 2% in 2024 at around 1.9, etc. So, and also we expect that unemployment will continue in its declining path. It was something like 2%, 12% at the end of 12.4% at the end of 2022, and we expect it this year at somewhere around the 11.5 most probably, and then it will continue downwards towards the R* rate in the following years. That's all for me.
Thank you, Mr. Stamatiou. Marianne, do you have any time for questions? Okay, so first question, food inflation is coming up and is still at all-time high. Given climate and geopolitics, isn't that going to keep inflation up for the foreseeable future?
I can probably start, Vasileios. So actually, you discuss about the structural shifts, and you don't probably see the factors. But in my mind, when I just analyze the factors and the structural shifts that we would see, in my view, one of the the geopolitics is one of the reasons we see now. More spending on defense, and this would, of course, imply higher cost. We see more rising food prices, and this is also due to the geopolitics and instability in general. And I see a number of also other structural factors, the aging of population, and all of these that they could probably just keep price levels high. That's why I'm not on the very, very optimistic side of the spectrum.
Great. Thank you very much. Thank you, Mr. Stamatiou, Mr. Gkionakis, Mr. Karimalis. Thank you very much for this insightful discussion. If you have any other questions, you can find the participants after the session. Thank you, everyone.